look at an example of carrying cost of inventory. Recall that I mentioned that we have all kinds of things that need to be considered when we are looking at purchasing our inventory. Again, management, it's their discretion as to how much inventory to buy. As I described to my earlier or lower level accounting classes, inventory management, it ranks right up there in importance, just like cash management. When we're talking about inventory, we know that we do not want to run out. If we run out, then we have what are called stock outs. If we run out, that is bad for us. Our customers, if they absolutely have to have the product, and we have some competitors who offer a similar product that will satisfy the customer's needs, then those customers will seek out those other vendors and suppliers, and there is a chance that they will not return to us. Okay, so stockouts are very dangerous, so we do not want to ever run low or completely run out of our inventory. On the other hand, we also don't want to have too much because we have high cost, and there are also some risk related to inventory, which I will highlight more in a moment. But what I'm wanting to push through right here is that inventory management is a lot like Goldilocks. We don't want it too cold, we don't want it too hot, we want it somewhere in the middle, just right. Okay, so we have to be very careful with managing our inventory. So not only do we need to evaluate the cost of the actual purchases of the inventory, but the costs that are related to the inventory. Every time we issue a purchase order, there are costs incurred just to get that done, let alone the fact that we're going to have all kinds of other costs, such as storage capacity. Okay, we've got fixed cost and some mixed items, such as utilities, security, things like that, that we incur for certain types of inventory. All right, cost, cost, cost. We need to keep our thumb on these as best we can. If we have a lot of money tied up in investing in our inventory, that cash could be used in another way. For example, invested in stocks or bonds, getting some type of dividend return or capital appreciation, some type of bond interest payments. What else could we do with the cash? We could use the cash to take discounts off our other vendor and supplier invoices, basically saving ourselves large sums of money depending on the types of discounts that they offer on their invoices to us. There are other things we could do with our money that we could generate some type of return on. Okay, so again, this also ties into, of course, our cash management. So inventory costs us money in a multitude of ways. We also need to be careful with inventory because there is a chance that it could become obsolete. For example, let's just say we're a cell phone part manufacturer, some type of little device or gadget that gets embedded into an iPhone. Well, we know that the iPhones are constantly getting updated to the newest and greatest model. What if that part that we manufacture does not get used in the next model? If we have invested and generated more units than what are going to be needed, then we have wasted our money. Obsolete inventory. What if it is some type of product that is perishable in nature? For example, consider things such as milk and eggs and stuff like that. It goes bad fairly quickly. Those kinds of products deteriorate. Okay, so we do not want to invest in too much of that, because if the demand is not there, then we have wasted money on a product that will become perishable and need to be disclosed, or not disclosed, but gotten rid of. So we need to be careful with our inventory management. We also need to take into consideration, however, that there are these things called quantity price discounts that a lot of vendors and suppliers will offer to their customers. This is definitely something that you could see depending on the type of industry you are in. I have mentioned before that I had a predominant amount of my career time in the metals and plastics industry, and we definitely could receive quantity price discounts from our vendors and suppliers, but we also passed along quantity price discounts to our customers. You guys should see some quantity price discount work in some of your other classes. I know for a fact that it's typically shown in the operations management course. You may see it also in a couple of the finance classes if you are an accounting and finance major. You also may see it mentioned and covered in some of the calculations that you guys will do in the management 4400 class, the strategic management capstone course, when you guys play the game against your fellow students. So if the quantity price discount is available, you may want to take it. So let's take a look at the case that is shown to us in the 15th edition text. It's on page 439. And let's consider what our carrying cost of inventory are depending on how much we buy at a time. We have an annual need of 250,000 units. How do we want to order those 250,000 units? We can place purchase orders whenever we want, and we can order a certain amount each time we place a purchase order. Well, for our example that we're going to look at here, we're going to look at it two different ways. Under option A, we can purchase or submit purchase orders 2 times a week in quantities of 2,500. Okay, and we're just going to say that's for 2 times a week for 50 weeks for a total of 100 orders. Okay, so 100 orders at $2,500 units for each order. And when we order them in those, we could just call them batches of 2,500, we will be able to purchase those at $64 per unit. And each time we issue a purchase order, we have a cost that we incur of $150. That's what it costs us to generate and process that purchase order. Now, when we buy in these small quantity batches of 2,500, the vendor or supplier is not going to give us a quantity price discount. All right, so we're going to pay the straight up $64 list price per unit. When we invest in inventory, like I mentioned just a moment ago, we are giving up the opportunity to use that cash for something else. There are a multitude of things we could use our cash for. But based on our scenario right here in the text, they are saying that if we instead invested that idle cash elsewhere, that we could earn a rate of return of 12%. Okay, so we're going to keep that in mind, and we're going to use that in a calculation to see what we're giving up by instead investing and holding extra inventory. Our second option is to instead purchase the 250,000 units in 8 orders. Okay, so 250,000 units divided by 8, we are going to be purchasing in quantities of 30,000. If we purchase 8 times a year, we will be able to get a 5% discount off of that list price of $64. So you guys can take the $64 and multiply it times 0.95 and get 6368. Or you can take the 64 and multiply it times 0.05 and get the 32 cents and subtract that from 64 to get 6368. Whichever way floats your boat. We do still have the $150 per purchase order, but again, we're only going to do this 8 times a year instead of 100 times a year. So we plan on saving money not only on the number of purchases, but also by buying in larger batches and receiving that quantity price discount. However, when we only buy 8 times a year, we're buying a lot of units at one time, and we are sitting on those for quite a bit of time. All right, so we're going to be using a lot more cash invested in inventory under option B than option A. All right, so let's go about calculating out our information. The example assumes, we love assumptions, that the units will be used uniformly throughout the year. So in other words, there's no seasonal fluctuations going on. That our average investment in the inventory is going to be the cost of the inventory when a purchase is received plus the cost of inventory just before the next purchase is delivered. Okay, so we're basically generalizing this and just coming up with an average amount that would be held. All right, so under Plan A, if we take 2,500 units at $64 a piece list price, we're going to get a total dollar amount invested. Divide that by 2, and that's going to give us $80,000 on average being invested in inventory. Under Plan B, we're going to take the $250,000 and divide that by 12 months, which gives us $31,250, and then multiply that times the discounted price to give us a total dollar amount, and then divide that by 2 to give us the average inventory of $995,000. Now, once we have this information, we can go and take a look at the actual calculation. Okay, so here is the total alternatives approach. I want you to notice that what we're doing here is comparing Plan A, which was making 100 purchases in batches of 2,500 units for the list price of $64 a unit, versus Plan B, making 8 purchases in large quantities of units and getting a reduction or a discount. All right, so first thing we're going to look at is the annual purchase order cost. If we issue 100 purchase orders at a cost of $150 per purchase order, we're going to incur $15,000 just in purchase order cost. On the other hand, under Plan B, if we only issue 8 purchase orders, it's $1,200 total. All right, so $1,200 is cheaper by $13,800 versus the $15,000. Okay, so it's cheaper to do Plan B if we're just looking at the purchase orders that have to be issued. In regards to the cost per unit, again, if we go under Plan A, they don't give us a discount. We're only buying these in batches of 2,500 units. We're going to pay $64 per unit. $64 per unit for $250,000 in a year. Means our total cost to purchase that inventory is $16 million. If, however, we do it in 8 batches over the year, we will get a discount. And $63.68 versus $64 is what we're going to pay. $63.68 times 250,000 units means we're going to invest $15,920 in inventory. All right, so we're going to save $80,000 by doing it Plan B instead of Plan A. All right, so these are positive numbers. To do Plan B, we could increase operating income by these amounts, right? But we have said we could have a 12% return on the cash if we instead invested elsewhere instead of an inventory. Now, under this particular method right here, what we're going to do is get the net of the difference between investing in one versus investing in the other. All right, so 995,000 minus 80,000 is going to give us an amount. And we know that we could actually do this one other way, and I'm just going to show you that if you took the 995,000 and multiplied it times the 12%, then that we would be giving up the opportunity to generate $119,400 by using that cash elsewhere. If we took that same 12% and multiplied it times the 80,000, we would get $9,600 that we're giving up the opportunity to generate by investing in those smaller quantities of inventory. All right, so we can literally subtract that second one from the first one to find out that $109,800 is the amount that we are looking at regarding what we could actually save. All right, so $109,800 more is what it would cost us to do Plan B versus Plan A. All right, so we want to net these numbers together, and notice here that we've got a net result of $16,000. This is $16,000 more expensive than this one. All right, so we can net the column, but we can net the row, and we should get the exact same result. So, as you can see, this one is cheaper by $16,000. So we should actually go with issuing 100 purchase orders. You guys can tell that the majority of this is due to that 12% return that's available on the cash. The other way to look at it is the opportunity cost approach. Again, you guys can see here that the purchase order line remains the same. It's cheaper to go with Plan B regarding purchase orders. It's cheaper to go with Plan B due to the discount. But when we get down here and we take and we add the opportunity cost to each one in regards to the 12% cash return, you can see that we're only giving up $9,600 in opportunity cost under Plan A, but we are giving a whole lot up, $119,400, if we do Plan B. Okay, I personally tend to like the opportunity cost better because, again, it's a cost. You can add it back. You know that if you do this one, you're giving up this much in opportunity. And if you do this one, you're giving up this much in opportunity. So this one is a little more simplistic in my opinion, but you guys pick which way you prefer. Notice again, we're still netting these numbers out, and of course we get the same exact result. We're just setting these problems up two different ways. This one right here is still $16,000 cheaper than Plan B. Therefore, we should go with Plan A.